So our first learning outcome statement here says interpret interest rates as one of three things. And those three things are required rate of return, discount rates, and opportunity cost. Let's start with the required rate of return. So our bullet point says an equilibrium interest rates that are the required return for a particular investment. Let's start with that phrase, equilibrium interest rates. Well, what that means is the interest rate at which the demand and supply of money match. So the required rate of return, therefore, is the interest rate at which lenders can borrow and investors or savers are willing to lend. Our second bullet point talks about interest rates as a discount rate. Well, this is touching on the time value of money that we're going to see a lot in future videos. Now, the time value of money says $1 today is not the same as $1 in the future. Why? Because if you give me $1 today, I could invest it and it will be worth more than $1 in the future. Now, this means essentially when we look at investments, we can value investments as the present value of future cash flows those investments are likely to generate. So what the analyst does is they forecast the future cash flows an investment is likely to generate. They then discount those cash flows at the investor's required return to get the present value of the future cash flows, and the sum of the present value of future cash flows is the theoretical value of the investment. We're going to see this in equity, where we look at valuing shares using the dividend discount model and the free cash flow model. Both are projecting future cash flows and then discounting them back to today using a discount rate, an investor's required return, to get the theoretical value of the security. We'll do it in fixed income, where we'll look at the cash flows on a bond, the coupon payments and the principal payments, and discount them at the investor's required return, the yield to maturity, in other words, to get the bond's price. And we even use it in derivatives, valuing things like options and forwards and futures. So a discount rate is simply an interest rate used to discount a future cash flow back to today's date. Let's give you a very simple example of this. Let's imagine I'm going to receive $1.10 in 1 year. And my required return, I'm going to call that R, is equal to 10%. So what is that $1.10 worth to me today? So I can take the future cash flow, $1.10, and multiply it by a discount factor, which is computed as 1 over 1 plus R, where we show R as a decimal. In other words, this would be 1 over 1.1. And when I do that, multiply 110 by 1 over 1.1, I get the value of $1. And what we're saying here, therefore, is to this investor who requires a 10% required return, $1 today is the equivalent of receiving $1.10 in 1 year's time. Or, if you like, if you found an investor that required a 10% return, they would be indifferent between receiving $1 today and $1.10 in 1 year's time. So discount rates are simply interest rates that we're going to apply to future cash flows so we can state them in today's terms, which we refer to as present value terms. Now, our third point here is we can view interest rates as the opportunity cost of current consumption, because future consumption could be greater if delayed. Okay, in other words, if you decide to consume your income, you are foregoing the interest that you could have generated if you'd saved your income. So the lost savings are the opportunity cost of consumption. When we turn to economics, we're going to say, well, look, we earn our income and there's two things we can do with it. We can either consume it or save it. And built into economics is the idea that we want to consume, and therefore, in order to get us to not consume and instead to save, a reward is going to have to be offered to the investor, and that, of course, is the interest rate. And therefore, if you decide to consume rather than save, you lose that interest rate. So the interest is the opportunity cost of current consumption rather than saving. Now, our next learning outcome statement here says explain interest rates as the sum of a real risk-free rate and risk premiums. So let's start off with this term real here. What does that mean? Well, whenever you see real in the syllabus, it means in the absence of inflation. So this is a risk-free rate in a zero inflationary world. And we've already touched on why we require a return, because of course we want to consume, and therefore in order to get us to save, we require compensation for that, and that is the real risk-free rate. It's what we would require to delay consumption in an inflationless world. Now, what drives the real risk-free rate then? Well, it's driven, therefore, by our desire to consume. The more I want to consume my current income, the bigger the reward will need to be in order to delay that consumption by saving. And what drives the desire to consume? Well, it's linked to things like the state of the business cycle. So in an economic boom where I'm very secure about my future earnings, my job, etc., I might want to consume a lot of my salary. Okay, and therefore the interest rate will be relatively high. But if I'm fearing a recession, I'm going to want to consume less and maybe set some of my income aside for a rainy day if I was to lose my job. And because I'm more likely, therefore, to save, then the real risk-free rate would typically be lower. So it's going to respond to stages of the business cycle. Now, as we said, real risk-free rate assumes that we're living in a zero inflation world. And of course, typically we don't. So what we're going to do is take that real risk-free rate and add expected inflation. Now notice this gives us the nominal risk-free rate, or at least an approximation. Typically, what we'd need to do to calculate it more correctly is take 1 plus the real rate times 1 plus expected inflation, okay, and then subtract the one we added. But typically in the syllabus, they ignore that multiplicative relationship and they just say, well, look, approximately, if you take the real risk-free rate and you add on expected inflation, that gives you the nominal risk-free rate. So our nominal risk-free rate is the rate that we require when our expectation of future interest is not zero. Why do we require a premium for expected inflation? Well, because inflation, of course, erodes the purchasing power of the future cash flows we're likely to receive. They're going to be able to buy less goods and services. And therefore, as a saver, I'm going to want compensation for that. Now, of course, we've been talking about risk-free rates, which means an investment with no risk. But typically when we invest, there are risks associated with that. So what we're then going to do is add on risk premiums for any specific risks that we can identify. Now, in this part of the syllabus, they've identified 3, but in practice, of course, and through other parts of the syllabus, we'll encounter many other risk premiums. First one is default risk premium. What happens if I invest, let's say, in a corporate bond, and then the issuer of that bond defaults, so I don't receive the coupons and principal payments when I'm expecting them? Well, that's credit risk, of course, or default risk. So therefore, when I'm investing, I'm going to want a return to cover me for the credit risk of that investment. Liquidity risk premium. What's liquidity risk? Well, when we talk about liquidity, typically we're talking about the ease of converting back into cash and achieving a fair value for your investment. And that's normally a function of the volumes of the security traded in the markets. So if you've got a security that is very thinly traded or not even traded at all in the markets, then you're going to have liquidity risk. So what is liquidity risk? The risk that when we convert our investment back into cash, i.e. we sell the investment, we have to accept a price lower than the security's fair value. And the final one we've got on here is maturity risk premium. Now, maturity risk premium says longer dated bonds, so bonds with longer time to maturity, have more price volatility than bonds with a short time to maturity. Now, the reason for this, and we're going to see it in fixed income, but the reason for this is longer dated cash flows are more sensitive to changes in discount rate than shorter dated cash flows. And remember, we can view the value of an investment or the price of investment as the present value of the future cash flows it's likely to generate. So longer time to maturity, more volatility of price. And again, as an investor, I'm going to want some return to cover me for that risk. So notice, therefore, we're taking an additive approach, take the real risk-free rate, add on expected inflation to get the nominal risk-free rate, and then add premiums for each risk that you identify.